Return on invested capital, or ROIC, is a financial metric used to assess how well a company is using its money or capital to generate profits. Think of it as a way to measure how efficiently a company can turn the money it invests into additional earnings. To simplify the concept of return on invested capital and make it easier to understand, let's consider a hypothetical example that involves a lemonade stand, which we'll refer to as Lemonade Inc. Imagine that you've started Lemonade Inc. with an initial investment of $1,000. This money was used to buy a lemonade stand, lemons, sugar, cups, and a blender. In this case, your total invested capital is $1,000, which covers all the assets and resources you need to start and run your business. Over a year, your company sells lemonade and earns a total revenue of $1,500. After paying for all the expenses, such as lemons, sugar, and water, the net operating profit after taxes is found to be $300. To find the return on invested capital for Lemonade Inc., we divide the net operating profit after taxes, in this case $300, by the invested capital, which is $1,000, to get an ROIC of 30%. To find the ROIC of a company, you can use stock screening tools like finchat.io. Interpreting return on invested capital involves understanding what the percentage you calculate actually means for a company's financial health and operational efficiency. A high return on invested capital suggests that a company is very efficient at using its capital to generate profits. It means the company is creating more profit per dollar of investment, which is typically a sign of strong management and a competitive advantage in its industry. Investors often look for companies with a high return on invested capital because it indicates the company can generate significant returns on its investments. A low return on invested capital indicates that a company is less efficient at turning capital into profits. This could be due to various reasons, such as high costs, poor management decisions, or intense competition in the industry. Sometimes a low return on invested capital might not be inherently bad. It could reflect a phase of heavy investment in growth opportunities, which might lower the return on invested capital in the short term, but potentially lead to higher returns in the future. Generally, a higher return on invested capital is viewed more favorably because it indicates a company is using its capital efficiently to generate profits. However, it's important to compare return on invested capital within the same industry. Different industries have different capital requirements and profit margins, so a high return on invested capital in one industry might be considered average or low in another. Moreover, it's essential to look at return on invested capital trends over time and in conjunction with other financial metrics. A consistently high or improving ROIC can indicate a strong business model and effective management. Conversely, a declining ROIC might suggest deteriorating business conditions or increased competition, affecting the company's profitability. Check out these videos to learn more about financial metrics.